So you want to live off dividends. The ultimate passive income, go to the beach, drink pina coladas kind of lifestyle. In this video, we're going to be talking about how much you would theoretically need based on a couple things. Your tax filing status, the amount of yield that you're getting on your investment, as well as what is the lifestyle that you want to live with dividend income. So do you want to go traveling the world, spending all this money, or do you want to be a hermit crab and go live in the woods? Those situations require different amounts of money to live those lifestyles. For this video, we're going to assume that you want to make $100,000 a year in after-tax money, and then your tax status would be married, filing jointly. So the big question is, how much do you need to fund your lifestyle? And if that's $100,000 a year, then that's how much you need in after-tax income in order to live that lifestyle. Also, are you going to be moving anywhere? So if you're moving from Chicago to New York, know that basically adjusting for cost of living, it's more expensive to live in New York. Or you could move into the middle of Mississippi and you'd be making bank with $100,000, right? So this could be adjusted based on where you're living. And then there's another couple important inputs that you have to ask yourself. What kind of dividend are you receiving? There's qualified or ordinary, which we'll go over. Is the account that you're taking the money out of a Roth 401k or an IRA? That's important. What kind of yield are you getting on the investments that you're taking? And then the amount of money that you've invested, right? So we've established you want to live off $100,000 a year, and married filing jointly is your status. Also, it's important to understand what kind of investment account you're actually getting the dividends from. So if it's in a Roth 401k or a Roth IRA, you're not going to have to pay taxes on any of those dividends because you got special tax treatment where you pay taxes up front, and then when you withdraw the money or you have gains on those investments or dividends, you don't have to pay any taxes. So that's why I also included it in the Excel spreadsheet saying, is it a Roth account? So there is a great Nerdwallet article that I'm using to reference here, and it goes over kind of the difference between qualified and non-qualified dividends. The non-qualified dividends would be the same as ordinary. So I'm not going to go too in depth on the difference between the two, but I'll link this article in the description below if you want to go through it. High level, basically, in order to be qualified, which you pay less taxes on, it has to be paid by a U.S. corporation or qualifying foreign entity. It has to be a dividend. And then also you have to hold on to it for a certain period of time. So you can't just be buying in and out of dividend stocks, collecting the dividend, and then expecting to pay favorable tax rates. And the reason it's important to distinguish between a qualified dividend and ordinary is because ordinary, you pay federal income tax rates, so that's much higher than a qualified dividend tax bracket, which essentially is the long-term capital gains tax, and so you get favorable tax treatment. So we have the tax status, the dividend type, is it in a Roth, and then lastly, you need the dividend yield and then how much money you'd have. But the dividend yield, let's go over this really quickly. And calculating the yield is a relatively easy formula. All you're taking is the annual dividend amount per share divided by the price per share that you're buying the stock at. Let's take a look at Verizon, which is a dividend paying stock and currently pays out $2.51 per share, and it's currently trading at $59. So what kind of dividend yield would this stock have? So the math would simply be $2.51 divided by the purchase price, or $59 per share, and that would give you 4.25%. It's also important to remember that the dividend yield is based on where you purchased the stock. So if it crashed to $50 per share and the dividend payout remained the same of $2.51, you would have a higher dividend yield because the denominator is a lower number. So your yield may be different from another investor's yield based on where they bought the price or bought the stock at versus where you bought the stock at. So if we plug in 4.25% with $2.7 million invested, after taxes, you'll have $109,658. Now, I wasn't smart enough to figure out how to do it where you put in the yield and the amount that you want in after taxes, and it would tell you how much to invest. It gets a little complicated with the taxes. So it's currently more of a plug and play kind of situation. So if you said you only had, $2 million based on your tax status as well as, the yield, this is saying that you're under the threshold of $100,000 that you want in yearly after-tax income. Also, something good to remember as an investor is that you can take this yield and multiply it by the amount invested to get how much you're going to get paid in dividends. So it'd be 2 million times this 4.25%, and you'd be getting paid $85,000 a year in dividends. Obviously, I mean, that's $2 million. That's a decent amount of cash, right? But it just goes to show how you can do a little quick calculation to come up with the dividends. And then to come up with the taxes paid, it's a little bit more complicated, as you have to look at these brackets and also pay attention to your tax status. Now, if you're thinking, okay, I can just pick a stock with an extremely high yield and something like 12%, and I need way less money in order to live off those dividends. Yes, but the question is that dividend sustainable? So there's two metrics that you can look at to see if a stock has a sustainable dividend and whether or not that may be cut in the future. Because the last thing you'd want to do is invest in a stock because of the high yield and then cutting that dividend, and then all of a sudden the stock price would also go down and you'd lose both the principal and then you wouldn't be getting paid any dividends. So double whammy. One of those metrics that you can look at is the payout ratio, which essentially takes the dividend amount divided by the net income that the company's bringing in. This way you can see how much of the profits that they're making as a company is getting paid out in dividends. So if this is over 100%, that means they're paying out more in dividends than the company's actually making in profits, which is obviously a red flag. One issue with the payout ratio is that it's looking at the net income, which can be manipulated with some financial engineering or one-time expenses. And if you want to strip out all that noise, you can also look at the free cash flow yield. So that's taking the dividend amount divided by the free cash flow. That way there's no funny business and it just gives you a different perspective. For me personally, since I'm younger, I tend to not focus on dividends as much, as these companies that pay a higher yield tend to have slower growth. And therefore I tend to look at real returns, which doesn't necessarily mean high yields when it comes to dividends. But if someone's looking to generate income or generate cash flow, dividends is one way to get paid as a shareholder. As you can see, there's a ton of inputs that go into figuring out how much is needed in order to live off dividends. So I did create that Excel spreadsheet. It's attached to my Patreon post. I'll link it in the description below, where I also basically wrote out everything that we talked about. And if you did enjoy this video or felt like you gained some value out of it, consider giving a thumbs up and then also subscribing to Main Street Wolf. That way you can get a little notification every time I post a video, and you can continue to learn about stocks, options, investing, personal finance, all that good stuff. So again, thanks guys for watching and have a great day.